Investing in the stock market can be a complex and overwhelming process, especially for those who are new to it. However, with the right tools and strategies, it can also be a lucrative and rewarding endeavor. In this video, we take a quick look at some of the top and most trusted techniques that seasoned investors use to invest in the stock market. However, you don't have to be a seasoned investor to learn and implement these techniques, as they will work for anyone, as long as they are understood and used correctly, of course. So with all that said, let's get into it. Fundamental analysis. This technique involves analyzing a company's financial statements, such as its balance sheet and income statement, to determine its financial health and future growth potential. Investors who use this technique look for companies with strong financials, including high profits, low debt, and stable cash flow. Sounds sensible and straightforward enough, I'd say. Technical analysis. This technique involves analyzing the price and volume of a company's stock, to determine trends and make predictions about its future price movements. This allows investors to look for patterns in the stock's performance, such as support and resistance levels, and use these patterns to inform their investment decisions. Diversification. This technique involves investing in a range of assets, such as stocks, bonds, and real estate, to spread risk and potentially reduce the impact of market fluctuations on an investment portfolio. The main aim of this technique is to help investors diversify their portfolio to minimize the risk of losing money due to the performance of any one particular asset. Dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the stock's price, in order to average out the cost of the investment over time. Investors who use this technique aim to reduce the risk of buying an asset at a high price by buying small amounts at regular intervals. Value investing. This technique basically involves identifying undervalued companies and buying their stocks in the hope that their price will eventually increase. With this technique, investors look for companies that are trading at a discounted price relative to their intrinsic value, which is determined by analyzing the company's financials, management, and competitive advantage. Momentum investing. This technique is predicated on buying stocks that have recently had strong price performance, with the expectation that their momentum will continue. With this technique, investors look for stocks that are experiencing a strong upward trend and aim to ride this trend to potentially generate returns. Portfolio optimization. Portfolio optimization basically involves selecting a mix of assets that are expected to maximize returns while keeping risk to a minimum. This is a technique that is used to build an investment portfolio that has the right balance of risk and reward for their specific investment goals and risk tolerance. Risk management. This technique involves identifying and minimizing the risks associated with an investment. Investors who use this technique aim to protect their investment portfolio from potential losses by diversifying their investments, setting stop-loss orders, and using other trusted risk management strategies. Contrarian investing. Contrarian investing basically involves going against the crowd and buying stocks that may be unpopular or undervalued, with the expectation that they will eventually increase in value. Investors who use this technique aim to take advantage of market sentiment and buy assets that are out of favor with the expectation that they will eventually become more popular, and when they do, they will be in a position to make some hefty gains. Long-term investing. As the name suggests, this involves holding investments for a long period of time, typically 5 years or more, with the expectation that they will appreciate in value over time. Investors who use this technique aim to ride out short-term market fluctuations and focus on the long-term growth potential of their investments. While these techniques are probably the most common examples of the many strategies that investors use on the stock market, this is by no means an exhaustive list. It is worth noting that no single technique is foolproof, and investors should really consider a variety of relevant factors when making investment decisions. Just like tool selection depends on the job at hand, the investment techniques employed at any given time will depend on a variety of factors, such as the individual stocks, market conditions, prevalent patterns, and gut instinct. Always make sure you do your research before you jump. Anyway, that's gonna be it for this video. Thank you for watching. We hope that you enjoyed it and maybe even learned something new. If you would like to see more informative content, please like, comment and subscribe, and we'll see you in the next one.